Okay. So good morning, everyone, and welcome to this session of the World Economic Forum. My name is Gianfranco Casati. I'm Group Chief Executive for Accenture Growth Markets, and I will act as a moderator of the discussion this morning. We have quite an intriguing question to debate, and I'm delighted to have a unique group of leaders with me ready to discuss this topic. If someone is wondering about lack of gender diversity on the panel, Jing is stuck in traffic near the convention center. She will be here anytime, and we will give her all the space that she deserves. But in the interest of time, we wanted to start. And just to remind you, the question or the theme for the discussion, the theme is the global growth imperative in emerging markets and how to calibrate the dilemma in between exit or expansion in growth markets. It sounds a bit like leave or remain, which is the big theme of the week. But I would suggest that we probably don't give the group of leaders here the same freedom the UK citizens had. And it's probably more on the remain and under what conditions we should consider for the multinationals to remain in the context of the emerging markets. And of course, when we talk about emerging markets and we are in Tianjin, China is a big central part of what we mean by emerging markets. I said the dilemma is in between the fact that even Premier Li yesterday mentioned the fact that China is now the second largest consumer market in the world, growing faster than any other market, indicating in a sense that the number one position is within reach. And China is already the single largest manufacturing market in the world. So when you think about that, you have very little doubt about whether companies should stay or not. But in the meantime, welcome, Jing. And thank you for making it despite all the traffic conditions. I was introducing the panel, and I think that the counterbalance of what I just said in terms of attractiveness of China and emerging markets is the fact that nowadays corporations, many corporations, not necessarily all the corporations, but in certain industries, corporations are experiencing a slowdown in growth in emerging markets, and definitely a profit dilution. So if we compare profitability of mature markets, in many cases, they continue to be accretive compared to the emerging part of the world. So in that context, we wanted to discuss more how global companies should recalibrate or consider their presence in China and emerging markets. And I'm delighted to have the opportunity to discuss the topic with a group of leaders, starting from Mrs. Jing Ulrich, who's Managing Director and Vice Chairman for Asia Pacific of JPMorgan Chase. Kevin Taylor, next to me, President of Asia Pacific, Middle East, Africa, and Turkey for British Telecom. Derek Shen, Global Vice President and President China for LinkedIn. Mr. Khalid Al-Rumani, welcome, who's Chief Executive for the Bahrain Economic Development Board. And last but not least, Professor Soumitra Dutta from the Cornell University. So very different industries, background, and geographies represented on the panel. And I would like to start answering how the leaders that are with us today see these markets and how companies should consider to calibrate their presence. Jing, we agreed that the sequence was that you would start. You still good to start, or fantastic? So the floor is yours.
Great. Good morning. Thank you very much for your kind introduction. So perhaps to kick off the discussion, I just want to put things in context. Everyone now is concerned about global growth and how global corporations can position themselves well amid all the challenges. So perhaps I can just, first of all, look at China in a global context. If you look at the global GDP these days, China, as we know, is the second largest economy, 11 trillion US dollars. It is smaller than the US, which is 17 trillion, and even smaller than the European Union, which is 18 trillion. However, China's growth rate is much faster. So if China is growing 6% or 7%, China's contribution to global growth is around 35%. The US economy is larger, but it's growing 2%. So the US is contributing to 17% of global growth. The European Union, of course, the situation is very fluid. With UK, the European Union has an 18 trillion US dollar GDP. Without the UK size GDP is about 2.6 trillion. So without the UK, the EU is smaller than the US. But growth rates, as we all know, in the UK and the European Union, in the wake of Brexit, clearly will go down. So we're not forecasting a recession in the UK or the EU, but we've basically revised down our forecast for both the European Union as well as the UK. So this means the contribution made by EU and the UK to global growth will be lower compared to even before. In fact, the contribution by EU to global growth is what China's contribution was back in 1996, around 8%. So if you look around the world, China is contributing an outsized proportion to global growth, around 35%. The US is contributing half that of China's contribution, which is 17%. And the EU, even including the UK, is contributing only about 8%. So that is why all the major global corporations are very focused on China. If China's growth stalls, that means global growth will suffer a major setback. Now, I want to just speak a little bit about the impact of Brexit on China and also the impact on foreign exchange markets, financial markets. So if you look at what's happening in the recent couple of days, we've lost about 3 trillion US dollars in market capitalization just in the last 2 trading days after Friday. Clearly, the situation is still very fluid, and Brexit will have major repercussions around the world, not just in the UK and EU, but also spilling over to China and the emerging markets. If you look at the direct impact on foreign exchange, this is actually very interesting for China. As you know, China has moved to more of a dirty basket peg, not just the bilateral relationship between the US dollar and the Chinese yuan. We need to focus much more on the Chinese yuan against a basket of 13 currencies. But in the wake of the Brexit vote, what's been happening is there's a flight to safety. So therefore, the dollar is strengthening, the Japanese yen is strengthening, and of course the British pound and the euro have been coming down. So as a result, the RMB exchange rate has been weakening against the US dollar. However, the RMB exchange rate against the 13 currency basket has been relatively stable, around 95. So I think in the coming few days, we'll continue to see high volatility in the foreign exchange markets. But what we can say is that the Chinese government is very intent on stabilizing growth. So they will use a lot of fiscal tools to try and increase investments in areas such as infrastructure. They will also stay neutral on monetary policy. We don't think in this current environment, any central bank in the world will be tightening interest rates, including China. Also, if you look at what's happening in terms of trade, China is the single largest trading nation in the world. The EU and UK are very important trading partners, but only 3% of Chinese exports go to the UK. About 13% of Chinese exports go to the European Union. So in the context of the global economy, the UK economy is still relatively small. It is only 1% of the global population. It is only 2% of global GDP. It only accounts for 3% of Chinese exports. So the impact is negative, but it's not devastating. I would also say that China is relatively insulated from what's been happening in the last few days because China itself is a continental-sized economy. There's a strong, large, expanding domestic market, and I think China has the wherewithal to really withstand a lot of the headwinds facing not just China, but also the global economy.
Thank you, Jing. Coming here yesterday, after reading the newspapers and still today, I thought it will be almost inevitable to have many of the conversations centered around what is happening in Europe in association with the Brexit. And coming here this morning, I met Kevin, and I said, Kevin, if there are questions or there is some consideration around Brexit, you are, of course, the uniquely positioned to discuss that. And Jing, you provided a very insightful perspective from a Chinese standpoint. Now, Kevin, you are, of course, leading one of the multinationals here in this part of the world. So you have a specific and very peculiar observation point when it comes to the dynamics of emerging markets. How do you see the role of multinationals and how the current volatility and the new trends of China and the new trajectory that China has taken are impacting multinationals like yours and other multinationals you are in contact with?
Sure. Thank you very much for letting me be here today. You know, from my perspective, you know, a third of global leaders are looking to expand globally. Still today, about 2/3 of companies are actually investing in products and portfolio and are continuing to invest in emerging markets. And you know, from our perspective in BT, probably a big surprise to a lot of people would be. You know, our revenues in our global services business are this year will be the biggest part of BT, so bigger than the divisions in the UK. Very surprising. So we've very much focused at investment. We're operating in 170 countries, and quite frankly, you know, we're following our customer base. Where our customers go, we go, and our customers are two areas. One is multinationals. And the others are emerging multinationals. So we're seeing multinationals continue the investment and continue the flow of investment into this region. And we're also seeing emerging multinationals, fantastic companies, grow out of, for example, China into world leaders. So, you know, we're actually seeing, we're very, very bullish about the market. We're a double-digit growth business here. and we have been for many, many years, and will continue to be so. So, I also think if you look at it, if you look at the fourth industrial revolution, if you look at the sharing of knowledge, the ability to look into new agile type of workings, I think, with communications, I think, I'm very, very excited about the opportunity going forward. From my perspective over here, it's around differentiation. Whatever you do, you need to differentiate in the market. For us, when we started here, really started here in terms of our investment over 10 years ago, we've been around 30 years, but real investment over 10 years ago, we looked at, from our customers' perspective, what's the financial value we can offer, what's the operation improvements that we can bring to the businesses that we deal with, what's the user experience or the customer's experience or customer's customer experience, what innovation can we bring to the market. And when we first came here, obviously there was masses of innovation. Now we're seeing China as being one of the great innovators in the world, certainly leading in certain areas. We're looking at the service model across the globe and bringing that to the table, and bringing time to market to the table. And if we bring that as a business case to businesses in the emerging markets, that's why we're winning over 70% of the deals that we're going in for. It's a very, very attractive market. And then if you look at, some of the really exciting things with the advent of new global companies, we're seeing global taxi companies, we're seeing global bookings and hotel type companies, and the ability for companies now to enter the market in an emerging market, or emerging companies in emerging markets going global, I think it's fantastic. And if you look at the advent of cloud technology, the ability to start a new business is really, really, effective. You don't have to put a huge amount of capital in. You can have an idea, you get it on cloud computing, you use one of the big players, and you're in the market. I mean, I think it's a fantastic opportunity for the entrepreneurial spirit of emerging markets to grow as well. So from my perspective, I've never been, I think this is a really exciting time. I know people sometimes concern about, is China slowing down a bit? Well, I'll take the China growth as it stands. If that's a slowdown, we'll take that. That's pretty good. I think, we do need governments to play a part there in terms of open markets from a regulatory position. And we're seeing more and more countries open their markets into more open trade and communications. That's very, very important to us. You touched on Brexit. We're all a bit surprised. Certainly went to bed after the Newcastle. I was in London, Newcastle-Sunderland results, and thinking, we'll be Remain, and then woke up in the morning and we were all completely shocked. But we did have plans, and I think there's no question that the EU needs the UK and the UK needs the EU, and out of this we'll develop models which hopefully, when sensibility comes back in play, which means that there's a functioning market, an open market, and obviously some type of labour movement of sorts. But there does need to be some type of deal. Iceland beat England at football last night. We don't really want a China-Iceland type of agreement, trade agreement that's in place. That wouldn't work. We need to do a bit better than that. But it's for us very exciting. But governments also play a part. The interesting thing is China invests over nearly $250 million a year in new developments, in encouraging net new business. I think that's fantastic. But we do need governments to go more and more in terms of open markets, and be interesting to see how things play out.
Yeah, I mean, by the way, the newspapers this morning, I saw they were saying Brexit continues because of the England leaving the Euros.
I'm a Welshman. We're already through. England's got a problem. So.
Okay. A good segue to what Kevin said, Derek, is the fact that what Premier Lee said yesterday was the China strategic direction is less natural resources, more human resources. To me, this is an extremely powerful summary of the direction China is taking in the context of human resourcing, meaning more innovation in the economy and the new economy emerging through what we call the platform businesses that make Kevin happy in this part of the world. You are part of that platform economy. So I suspect that your way of looking at the potential of the emerging markets is the glass is half full or even more than half full in a sense.
Yeah. So first of all, thank you, for having me here. So today's topic is actually very interesting. So I'm more talking from a global internet company perspective. So LinkedIn's mission is to connect all the professionals to make them more productive and successful. So exit is not an option for us, right? So we have to get into every single new market, including China, right? So we have some kind of theory. So for global internet company to get into new market, to operate in new market, there may be two different models. So one is the more integrated model. So the other is the more startup model. So we call it LinkedIn China model. So for the smaller economy, so which also in a very similar culture, similar competitive landscape as US. So as we think you need to take a more integrated approach. So the idea is like the matrix organization, the less customization, and more better aligned with global strategies. But for the bigger economy, for example, like China, right? So with a much bigger upside, and also with very severe competition and unique environment. So maybe you need to take a more startup approach. So we call it LinkedIn China model. So the idea, the LinkedIn China model is if you look at the fact, no global internet company succeed in China in the past. There must be a reason, right? So in our theory, just a matter you need to do three things better to make it work, to have a chance to succeed. So one is about the people. The second is about the structure. And the last one is about the product. So one about, about the people. So instead of a professional manager, you need an entrepreneur to run your local business in this kind of bigger economy, right? And also build an entrepreneurial team around this person. So that's about the people. About the structure, it's just a matter to give China team or local team more autonomy, bigger decision-making power, and stay nimble and move fast. So for example, for LinkedIn's case, so why I joined LinkedIn 2.5 years ago in China, I was the only employee in China, but I was directly reporting to the CEO. And also, we are a joint venture in China. So we have two external VC investors. One is Sequoia China, another one is CBC. We also have a LinkedIn China board. So 5 members on the China board, we talk about LinkedIn China every quarter. So all this kind of effort is just to make structure-wise, to make LinkedIn China, to give LinkedIn China more autonomy. So the last one is about the product. So we're talking about you need 100% local product. So the idea is the global, the customized version of the global product may not be working for this kind of a bigger economy, more independent economy, right? So you need 100% local product. So for LinkedIn's case, besides the global product LinkedIn, we also launched a China-specific professional social network called Chi2. So Chi2 is a mobile-only and Chinese-only application, and plus it's 100% controlled, owned by the China team. So that's talking about the structure, right? So so we talk about the LinkedIn China model. So actually we have been inspiration, right, for a lot of global internet company trying to get to entering China. So I got a lot of phone calls, people asking my idea what's your model works, so how we can learn from you, because it's kind of inspiration, because no one succeeded in the past, and we have a chance to succeed.
Well, it's fascinating because when and if we read China and emerging markets through the lenses of the Western press or magazines, you have a perspective which is of a certain type. And then you come to growth markets, come to emerging markets, and experience directly what's going on the ground, and the perspective is completely different. And what we are hearing this morning is exactly in that goes exactly in that direction. Flying with some of the best airlines in the world in a different part of emerging markets, Khalid. You have probably a slightly different perspective, and I would say, what is the world like in an environment where less natural resources has also had implications in terms of consumption of oil and oil price? And so how the Middle East in general and Bahrain has recalibrated the strategy in terms of a portfolio of investments that you are welcoming and you see coming compared to the recent past?
Sure. First of all, it's a delight to be here. I think that the region is, as you mentioned, recalibrating. I mean, any company, if it had seen its revenue drop by 60 to 70% in 18 months, would have to recalibrate. So you can imagine a whole country. And a lot of the countries are looking at that revenue shortfall and beginning to think not only about how to manage expenses, but how do you generate growth when the government will necessarily have to generate or drive less of a role in the economy. So I think encouraging the private sector, allowing the private sector to be an engine of growth. Every country in the Gulf is looking at that. We've heard of Saudi Arabia's Vision 2030 and the vision they have for having the private sector play a bigger role. And I think that looking at what sectors outside of oil will drive growth. In Bahrain, we've been probably blessed with having less oil than our neighbors, and it's allowed us to diversify our economy. Our economy is about 80% diversified away from oil. Oil only plays a 20% role in the economy. So we're seeing, obviously, the fruits of that pay off today. But I think every country in the Gulf is beginning to think, how do I drive growth? Where will the private sector invest? Where is my competitive advantage outside of oil? And I think that when we look at it in our country, we think that the government has to provide several elements in place to allow the private sector to drive it. Now, we can look at outside capital and inside capital. One of it is infrastructure. You've got to have advanced infrastructure. We know that infrastructure drives growth. The estimate in the Gulf is that there is about $480 billion the governments will spend on infrastructure in the next 4 years. If we look at Saudi Arabia, probably in the past, 80% of that has been invested by the government. Only 4% has been in public-private partnerships. That will drastically change in the next couple of years. So allowing the private sector to drive investment in infrastructure is probably a trend. Second is the legal position. How do you provide the legal framework, intellectual property protection, arbitration? And third is, how do you develop skilled labor to allow your labor force to be a competitive advantage? But I think just on this topic of multinational corporations and investing in emerging markets, I think HSBC, just to plug HSBC here a bit, had it right in their slogan. You've got to think global, but act local. I think Derek mentioned that. Multinational corporations, if you ask them, their biggest competition probably is the local competition. They're playing against very advanced. So local competition now has access to technology and know-how to import and to become an aggressive competitor. And they're probably more plugged into local value supply chain. So we play host to Mondelez, formerly Kraft, which has a processed cheese and a beverage factory. And one of the first things they did, they started their plant in 2007, is they said, very profitable plant, one of the most profitable for them around the world, is they said, we want to reserve plots in the industrial park to allow the intermediate producers to also set up here. We want to make our supply chain local almost from day one. And I think that was one differentiating factor that made them successful. So you've got to customize not only your product, but your supply chain, your workforce. And that's how I found MNCs are going to be successful when they enter in the emerging markets.
Thank you. I do recognize what you say in the discussion with many multinationals that are our clients and continue to invest and have focused on the entire value chain, and that is a key element to succeed in some of the emerging markets for sure. Professor Dutta, it sounds like it's a remain. And we didn't have much doubt about that. On the other hand, it's a fact that the world economy is looking at emerging markets in a way which is different from the recent past. So in the meantime, you have the new economy emerging, you have telecom and the infrastructure companies that continue to be very bullish on emerging markets. We also have entire economies. I can mention Brazil, I can mention South Africa, also Australia to some extent, that were dependent on the export of natural resources into China that are struggling, and they need to find their own new normal. So how would you describe this new normal, and how would you see corporations should, as we said, recalibrate their way to look at growth markets?
Well, thank you very much for the question, and thank you for inviting me to join the panel. And it's absolutely fascinating to listen to the different perspectives. And I think we all agree that organizations, multinationals, have no choice but to be active in emerging markets, and that's a given. But let's also think about, why do companies actually go outside the home markets, be it from developed markets or emerging markets? And in general, there are three reasons why companies choose to look outside. The usual one is for customers, and that's where the growth theme comes in. So are the customers buying more of my product or not? Is it growing or not? That's the usual one, and that's traditional. A more recent one has been around resources. Traditionally around natural resources, but I think more recently around human resources. I think your company is one that has a huge operation in India because of talent in the country. And third is very important, is around knowledge. There's a lot of knowledge in local markets, which is extremely valuable today for organizations, not just for succeeding in the local markets, but for succeeding globally. So if you keep these three perspectives in mind, growth is just one element. And I think it's important to find a balance across three elements. And it is true that every country, every economy goes through cycles. When we had the financial crisis in the US went through a dip. Does that mean that companies should leave the US and go somewhere else? You have to be able to take a longer-term perspective. You asked a question about how do we actually do this? And I think we have some good examples in the earlier comments about how companies are doing it. I think I would just add to it in two different ways. The theme of this entire meeting is around the fourth industrial revolution. Clearly, technology in its broadest sense is impacting all companies in every way. If you think about where's the locus of technology innovation going to lie, it's no longer a given that locus is going to be in the West. Let's take internet as a simple example. The center of gravity of the internet is moving from the West to the East. We know that. It's not just in population numbers, but also in terms of penetration rates. And now the penetration rates in China, India is much lower than America and Europe, but it's rising. As the center of gravity moves to the East, what is the likelihood that new innovative business models that emerge more from this region as opposed to the traditional region in the West? It's hard to predict exactly how that will evolve, but it's quite likely that a lot of the new innovation models are going to emerge in the East. The example you gave from LinkedIn is a wonderful example. of something you're created out here because of local conditions, which eventually might migrate to other parts of the world. GE's example of reverse innovation, innovating in less developed markets and taking that kind of innovation and succeeding in the global market is another kind of a theme. So if you ask the question for MNC to be competitive in the global space, it has to be able to seek and integrate these different sources of innovation across the world. So to be competitive, to be innovative, to leverage technology in whatever form it makes sense in the business, you have to be able to tap into these markets. So there's a very real strategic reason why it's important to be a player in these markets. My last comment is really around what I think is a very important theme that was mentioned by you about, think global, act local. And I think that's something you gave examples of how that's happening. But when you look at a company, MNC especially, and you ask the question, what is the home country of this MNC? Okay? It's a very important question, but I would argue that for the vast majority of multinationals, still the home country stamp is very strong. And a very simple test is you take the top, 50 managers, 50 leaders in the country, and ask the question, what is the degree of congruence between the top leadership of the company and the market base where it's selling its products or is actually active? And in most organizations, there's a very low congruence between those two elements. And what happens in those organizations is it is very hard to sustain your competitive edge if you cannot change the DNA of the culture of your organization. And I think that's going to be the challenge for all these new emerging multinationals from Asia, from Latin America, from Africa, who are now trying to go global. Chinese companies trying to enter into India or vice versa, or otherwise in Latin America. And these companies have to also change the DNA, and that's going to be a very big challenge going forward.
Well, I couldn't agree more. And in fact, when I'm asked where our headquarters is, the answer is there is no headquarter. It's quite some time that we don't have any headquarter anymore. And that creates a much better intimacy with the different markets in which we operate. So it's a very important and valid point. And I think that local leadership and local talent are the other topics that you mentioned that are extremely relevant in the strategy of multinationals when they want to be successful. But we have time for some questions for the audience. Any question?
Hi, Lourdes Casanova from Cornell. I was wondering if also part of these investments are, and it has been mentioned in the panel, by the competition of local multinationals. So now, in any industry, whether investment banking, social platforms, etc., you have a local strong winner. Yesterday, China Daily said that, again, foreign cars in China are experimenting challenges in terms of sales. So how do you see this competition going forward? And the question is directed to all of you, but mainly JPMorgan or even LinkedIn or BT in China. So how they feel about the local competition.
Thank you. Before we answer, can we take 2 or 3 questions so we have any other question from the audience?
My question is that with more and more multinational companies getting to the different regions, so local governments are requiring the multinational companies to take more and more responsibility for the local communities. Otherwise, I don't think MNCs will succeed in those markets. So my question for the panelists is that, what's the recommendations for the MNCs to tightly integrated into the local community and not become a value extractor, become a value contributor to the region's communities.
Thank you. So I think, in a sense, the two questions are about how the multinationals get more local to really be able to compete and win in the short and in the long term with the local players that are emerging. Jing, I'm sure you have a perspective from a JPMorgan standpoint.
You know, in China, in the financial market and the banking industry, we have a very interesting landscape. The Chinese banks these days are the largest in the world in terms of assets, in terms of market capitalization. So if you look at the top banks in the world, in terms of their size, 4 out of the 10 are actually in China. And of course, in China, we work with a lot of the domestic banks. They're both competitors and partners. But foreign banks in China, in general, have a very small market share. All the foreign banks combined have about 1% market share. The 4 state banks in China still dominate the domestic market. However, the foreign banks do have their advantages. In the case of JPMorgan, we advise many of the top global institutions as well as Chinese institutions. These days, a lot of the investments are actually towards outbound investments from China. So as our Chinese customers go global, we are advising them on their outbound investment strategy. So if you look at the domestic financial and banking landscape, of course, the 4 state banks dominate. They're deposit-taking institutions. They together account for 60% of the market share and deposits in the domestic market. Foreign banks are very small, but the share is very limited. So what this means is that we need to tackle areas where the domestic banks don't have a lot of expertise. For example, within JPMorgan, we have 4 main businesses, from the corporate investment bank to asset management, which also includes the private bank. We have treasury services and the commercial bank. Now, here in China, we are firmly committed to serving our customers, both multinationals and Chinese companies. One of the major initiatives is serving Chinese customers which are going overseas. If you look at Chinese outbound investments these days, they're every year increasing at a very rapid pace. This year in 2016, even though we're only halfway through the year, we already have announced deals topping the entire year of 2015. Many Chinese companies, including state-owned companies and private companies, are investing overseas. For example, a Chinese company called Haier has acquired GE's home appliance business. We have private groups like Fosun and Wanda acquiring assets in the US in terms of entertainment, hotel assets, etc. So we're serving many of these customers as they invest overseas. We don't compete with the domestic institutions when it comes to serving retail investors. JPMorgan is a wholesale bank. We basically bank major multinational companies and state-owned companies as well as private companies, but we don't take deposits from retail investors. So the competitive environment is evolving, but I would say here in China, as foreign multinational corporations, you need to keep in mind the relationship with domestic competitors is actually very complicated. You're not just competing. In some areas, you're actually cooperating.
Correct. Kevin, maybe one quick comment on being active in the local communities as part of being present in the emerging markets.
I mean, it's a great question, and you know, we're passionate in BT around when we're BT in a country, we're in a country, and it's BT in India, it's BT in China, it's not global BT in. So over the last 10 years, I passionately focused on making sure that the local community actually runs BT. So in India, it's an Indian team running BT. In Japan, it's all Japanese. In Accenture, in Australia, it's full of Australians, right? You know, it's I don't know if that's good or bad, but I'm joking. But they're a great team down there. But you know, I'm absolutely passionate about ensuring that the local culture is what's driving our business. It's really, really important. Also, then the corporate and social responsibility of us as a company, of BT as a company, is very, very important. We have the same standards globally. So we have a huge focus on our corporate and social responsibility, on our responsibility to the community. We have 86,000 employees globally, on making sure that, you know, the academy of BT, the training, the education process is handled on a multicultural, multi-language basis across the globe, as I'm sure they do in Accenture. And that's a massive, massive area to make sure that we're acting global from a strategic point of view, but local execution, and it's working very, very, very well. So, you know, we are passionate about that. But I must say, it's quite amazing, you know, when you talk Jing, you know, less than 1% of the financial services sector in China is international. It's probably less than 0.5% in China are international communications. Telecommunications, if you add it all up together. So what I would also say as part of the deal is, you know, China today can operate very freely in the UK, and it does with huge investments. Don't know if that will continue, I hope it does. I'm sure it will. But it needs to be a two-way ticket. Today, you know, we've got great partners here, you know, and China Telecom, China Netcom, but the ability to do business in this sector is very important. So we do need regulatory freedom to be able to deal directly with customers, to build customers in China. That's part of a two-way deal. And I think that's from our sector, then you'll see a more balanced local growth with international growth. And I think that will be good for the economy, good for jobs, good for innovation, good for globalization of Chinese companies. And so I think it'll be a win-win all the way through.
Yeah, and I have to say that this is exactly the same experience that we have with Accenture. The presence in the local communities is a key element also to detect and nurture the talent of the future, and is particularly visible in India, in China, and in Southeast Asia in general. So it's a very important point that multinationals need to continue to focus on, to continue to become as local as possible, because that is a big difference in the way we characterize our presence. Very quickly, I'm conscious about the time. Khalid, this point of presence and sensitivity around the local communities, the notion of the value chain, the full supply chain, is a way to answer that question, I guess.
Yeah, definitely, I guess from cost perspective. And I think hiring locals, making it a much more local operation is one, but also giving autonomy. Giving autonomy to the local operation to make decisions that are unique to that area. Sometimes I've seen the successful companies. I mean, Huawei, for instance, which has a presence in Bahrain, began to think about how do I hire technicians, and they found that there was a scarcity of it. So they got involved in the local education. They began to take internships. They began to make decisions that they needed to make to partner up with vocational education to get the right kind of employees that could allow them to become local. So giving autonomy to the entity, it could be on product, it could be on making a product. McDonald's has a halal burger. They have a vegetarian menu in India. Or around hiring, or around introducing practices. That makes them much more competitive with the local.
And you see that, and you see that.
And we see that with MNCs that succeed, that think in the long term.
Okay.
Don't see it all the time. But I think it's, when we talk about how multinationals will need to be successful when they go outside their home market, I think they need to give autonomy to that local operation. I think they need to hire people from the local market. I think they need to deepen their supply chain. So it's a number of levers that they need to play, and then they begin to become an entrenched player in that home market. And I've seen that with, as I mentioned, Huawei doing it in Bahrain. I've seen that with Mondelez we talked about. And I think that's made them successful, profitable, by the way. And seen, by the way, when you begin to become an employer of locals of size, then the government begins to think of you as a very important stakeholder in that country. It gives you leverage
Correct.
in terms of the way the government
Correct.
Introduces regulation. So it actually protects you as a player in that home market.
Derek, a quick comment on the fact that when we talk about local and global, you made the reference to local products. But for a company like yours, and for companies in the platform economy, the way I like to call them, this notion of local and global is different because there are no barriers. There is no. How do you see the sensitivity, the talent to be part of something which has a local manifestation, but in fact is a global business, is a global way to connect people in between themselves? Any consideration on that?
So when we get into China, we strongly believe LinkedIn have a chance to succeed in China because of our global network synergy, right? So people want to join LinkedIn because of the global network synergy. But at the same time, after a year of operation in China, although we see like strong growth on LinkedIn membership, but at the same time, we also see problems. That's why we have a separate product. So we see three problems. One is LinkedIn is a product like designed around email, around PC. But in China, it's all about mobile, right? So if, for example, LinkedIn just very recently supported a feature like cell phone number registration. But in China, for any mobile application, 4 years ago, you have to support cell phone number registration. Just give you one example. So LinkedIn product before is not good enough for China market, not mobile enough. So the second problem, maybe more related to your question, is like in China, we realize there may be two segments of professionals. One is the more global one. So they are like English-speaking, multinational, overseas experience. But at the same time, we see there are another maybe bigger segment of more Chinese professionals. They are younger and they grow up when China is strong enough. Or they feel like they want to succeed in China. In a way, they don't care so much to go to other country to be successful. So they care about how to succeed in China. So our product before may not be good enough to serve this segment. That's why you need a Chinese-only mobile application. And the third one is, although we're trying pretty hard to building plug-in for the global platform or global product, but that's not quick enough to face local competition. So that's why you need a separate product, which fully controlled by the local team. And then you can make change very quickly to face local competition. So those three reasons, that's why we build a separate product in China.
Thank you, Derek. Yeah, very, very insightful, and I see that, recognize that logic in many of the successful multinationals that we observe here in China. Professor Dutta, the last question before we close, and I do recognize that it would require more time, but in all the discussion, the new economy raising, the economy of the platform growing, the old traditional companies recalibrating in terms of presence, there is a social equation in it. And yesterday, Premier Lee was very clear. He said, I mean, the new is coming, and it's coming very fast, but the level of employment that the new is generating is not necessarily commensurate to the level of employment which might become at risk when we talk about restructuring the overcapacity of traditional industries. How do you see that as an element of social discontinuity going forward? Any thought, particularly in the large economies like China and India, these might be a significant element in the years to come?
Yeah, that's a big question.
I know. I know.
I cannot do justice to it fully in probably even much more time. But Let me give you 2 quick thoughts. So first of all, if you look at the history of technology and jobs thus far till today,
Right.
it is well known that technology has created more jobs than destroyed jobs so far. So far, technology has enabled creation of new sectors, new jobs, as opposed to destroying jobs.
India is a big example, yeah.
The big question, which is unknown, is what happens in the future as artificial intelligence technologies becomes more and more sophisticated. And at what point do they really start replacing skilled labor en masse? And that's really a big question mark, which is not really clear, the answer. There's one school that says, it's going to be terrible and a lot of skilled labor will lose their jobs. Another school of thought says, well, AI will never really replace human beings in the true sense in the near future, but will, if used properly, will help augment the abilities of human beings and make human beings, skilled people, more better and more capable in what they're doing. So which direction the future goes and it remains to be seen. I guess we'll debate that in a future Davos meeting.
Exactly, so. exactly. Well, we're coming to the top of the hour. I want to say thank you. I know there are other questions in the audience. We may take the questions as we adjourn the session. Thank you for the leaders who participated to the panel. I think the direction is multinationals will stay, and we need to figure out the way and continue to be vigilant and adaptive to the evolution of the market. Thank you again, and looking forward to a conclusion, an exciting conclusion of the WEF. Thank you. Thank you all.
Thank you.